Hello, and welcome to the Weekly Watch podcast series. I'm John Briggs, Global Head of Desk Strategy. This series helps you cut through the noise of global financial markets with a quick take on the upcoming trends to watch. Well, the first week of 2021 was, for most asset classes, an extension of what we saw over much of 2020, the everything rally. The top volatility-adjusted asset for the week was Bitcoin, which was the top performer in 2020, but equities, Asian currencies, and commodities, and thus also the materials sector within equities, also performed strongly on the week. A big driver of the moves was the rising expectation of additional fiscal stimulus out of the U.S. This arose from the result of the Georgia Senate elections, where both were secured by the Democratic Party, giving them a razor-thin majority in the Senate and a Democratic sweep of government. I say sweep, though, and not a Democratic blue wave, because a blue wave would have implied a much larger majority, thus the greater ability to pass stimulus. The very narrow majority makes it much more complicated to get large-scale stimulus passed. To be clear, we do expect some additional stimulus will come through, but time will tell on the size. Even so, however, markets can run on the idea of increased fiscal stimulus out of the U.S. for the next several weeks, especially as we head to inauguration, and with Biden floating the idea of starting off with a very large, big-ticket number. So despite increasing concerns about the long-run ability to get stimulus through, and also concerns about frothy markets, which I share to some degree, the current mood is likely to continue. That should also continue to help many assets that rallied this past week, including commodities, and we are still bullish on oil tactically. And this should in turn help oil currencies, and especially Aussie dollar, for several reasons, including higher metal prices, better data out of China, and just ongoing better COVID management in Asia more generally. But the fiscal story was not the only story helping markets. We also saw ongoing evidence of resilience in the global manufacturing sector, and indeed European economic data as well that was released showed good resilience. While the manufacturing resilience was the case in the U.S. as well, weak employment data there showed a faster deceleration in the labor market than even we were looking for. This, and underperformance regarding virus management from an outgoing administration that is clearly not focused on that issue, reinforces our argument that on a relative basis, going forward, the U.S. might start to look a bit softer here than Europe. This should lead to higher euro, and even as U.S. bond yields rose last week on the fiscal stimulus story, U.S. weakness should help arrest that move and lead to narrower bond spreads versus Europe and even the U.K. Speaking of the U.K., we get UK GDP this week, where we expect below consensus, minus 1.8% decline in GDP in November as the second national lockdown hits. Even so, we think sterling will remain resilient, aided by still positive tailwinds from the passing of Brexit, and as we see much of the downside risks, including COVID, relatively priced. Other big events for the week we are watching is the U.S. inflation data, though markets have continued to price in future inflation even as spot inflation prints have been weak, Q4 U.S. earnings, which kick off on Friday, and the political noise out of Washington. Regarding the recent events in Washington, I think they're going to have an important social and political impact, but for markets, less so. Even if Trump is impeached or removed from office, it's a very short time to the January 20th inauguration and the start of the Biden administration. And ironically, an impeachment may even help as you make a powerless what appears to be an increasingly unstable president. Either way, Trump's long overdue concession this weekend reduces any sort of market risks on this front greatly. The risks we do continue to focus on are the COVID virus trends, efficiency of vaccine distribution, and we continue to look for assets to start to become a bit more differentiated around out or underperformance on both these issues and just economic performance, and less of an everything rally as we get deeper in the year. I hope you have enjoyed this episode of the Weekly Watch. Please subscribe to our channel to get future episodes. We also encourage you to explore more of our content on our website and other social media channels.